And so the one thing to keep in mind is many times limits that come with these proposals tend to be fixed. They don't float.
Hello, agentpreneurs, and welcome back to the Daily List Report. Today, coming to you from beautiful Big Bear, California, on location, so to speak, but a nice change of scenery for me and George as well, even though he's coming in via remote. As always, George is back on the show. He's been a tremendous value add. You guys love his content. He's going to talk about the latest updates in the market and what's happening and the trends. And it's so important to stay close to all of this. A couple things before we get started. One is realtor.com/research. Great place for you to subscribe and get notifications of some of their studies via email. There's a lot of great information here. Definitely check that out. Today we're going to talk to, and it's going to be linked below, a new partnership between Realtor.com and the Wall Street Journal, publishing the Emerging Housing Market Index. So we're going to cover that today as well. And that's going to be great. Of course, while you're here, please consider subscribing to this channel. Click that little bell so you're notified of all future episodes. And without further ado, let's bring George back on the show. Hello, George.
Hi, Randy. Good to be here with you again.
Always good to have you. Always good to have you. I know you've been appreciating the lovely view that I have here today. This is quite nice, isn't it?
It absolutely is. After a year of virtual backgrounds, I love to see a real one. It's inspiring.
Absolutely, absolutely. You're going to try to do more of this, right? That's the beauty of sort of work from anywhere and the flexibility and freedom that many of us have now, right? Is to be able to do something a little bit different. George, why don't we kick it off here today? Actually just spend a moment in the context of this new report, right? This new partnership with the Wall Street Journal, the Emerging Housing Markets Index. What is this? How should we be utilizing this information?
So we partnered with the Wall Street Journal for a really, from my perspective, useful and interesting project. And that is, after looking at markets for so long and saying, well, demand is really up, really strongly, inventory is extremely tight, it's driving prices really high, and all this fueled by low interest rates. What is it that makes real estate markets today attractive to buyers beyond that? Because in truthfulness, we've already seen these trends take place 2-3 years ago already, meaning a lot of younger buyers looking for affordability away from high cost areas and people moving around. The truth is, right, people don't move somewhere just because housing is cheap. They simply move somewhere because there's a complete package. And so with the index, what we did, we looked at the market indicators, but we complemented those with indicators for the strength of the local economy. We looked at entrepreneurship, diversity, the share of foreign born. We looked at quality of life. We even considered things as, to me at least, interesting as the prevalence of Starbucks, Trader Joe's, Whole Foods stores, really as indicators of the fact that people are looking for quality of life along with affordability and a strong economy. So when we put all these things together, the list that emerged was quite interesting. We had some markets that were not surprising, right? Austin, Texas. I would say Austin, Texas was really a pioneer in this move towards markets that offered a lot of talent, a strong local economy, and affordability. In fact, we saw Bay Area companies start to move there 10 years ago.
Absolutely.
But some of the other markets on the list, right, were quite interesting. I mean, topping the list is Coeur d'Alene.
Yeah.
And I think for many people, that was a surprise, as in Idaho, really. But when
it was, and I'm pulling up the list on screen right now just so people can kind of follow along. But you're right. Number 1 is Coeur d'Alene, Idaho. Number 2 is Austin, sort of Round Rock, Texas. But please continue, George.
Well, absolutely. And since you have the list, you go down through there, right? Springfield, Ohio, Billings, Montana, Spokane, Lafayette, Indiana, Reno, and then 2 markets in New Hampshire, Concord and Manchester. And then complementing the top 10, of course, Santa Cruz, just in the south of Silicon Valley area, right on the ocean. What's unique to me about these markets is that none of them are necessarily high density metropolitan downtowns. But what they do have, when you look at a map for many of these cities, they are very much within relative proximity of a major employment center.
Yes.
In the case of Springfield, Ohio, it's right between Columbus and Dayton, two big and growing economies in Ohio. Spokane, similarly, right, not far from Seattle. Similarly, with Concord and Manchester, for many people who might not know, they're literally within a 2-hour commute from Boston. And similarly with Santa Cruz, you're literally 45 minutes with no traffic, mind you, I guess, from San Jose, Santa
If you're
Clara.
lucky. Yes.
If you're that's that's why I had to drop in with no traffic. I'm not sure that there is ever time with no traffic.
Yes. Yes.
Um, but what's interesting about these markets, and there's a nice roundup. We looked at a large number of metros, then you can find the list available. What's interesting to me, and Coeur d'Alene, I think, absolutely embodies this. These are markets that have really have seen their economies diversify and strengthen over the last decade. For many of these markets, which used to be small, maybe many times, like in the case of Coeur d'Alene, vacation destinations, a lot of the communities made a lot of plays in attracting companies that diversify their local economies and employment base. And in addition, comparatively speaking, they offer much more affordable housing. And this was key, which I think the Emerging Markets Index did such a good job of highlighting, they offer incredible quality of life. I mean, think about the fact that Coeur d'Alene, for example, is located on a lake in the mountains. There are 3 ski resorts in the area.
Absolutely
There's
gorgeous.
Yeah, water activity. It's beautiful. I mean, similarly, when you look at some of the other markets, New Hampshire, Santa Cruz, these are areas that embody what, in many ways, today's people are looking for in a post-pandemic lifestyle. And
Absolutely.
we've talked about this before. I think that if anything, the pandemic has really pushed most of us to reconsider what is it that we prioritize. And in addition, of course, fueled by the remote work reality, it made apparent that proximity to an office is not necessary in this environment. So people obviously have opted with their dollars, mind you, to purchase in these markets. And I think this points the way forward as to how economies and housing markets are going to look. And
Yeah.
to me, and the only thing I'll add, it's obvious that companies are recognizing this new reality too. I mean, look at the fact that many companies and tech companies are at the leading edge of this, have recognized the fact that the markets that gave birth to them, in a sense, have become victims of their own success in terms of lack of affordability. They are looking for additional office locations, satellite campuses, or even second headquarters in other places, right?
Absolutely.
Amazon's was much publicized, but Amazon is not alone. Apple just announced, 2 weeks ago, that it's building an East Coast campus in the Raleigh-Durham Research Triangle area. So it's obvious that the impact of housing is really weighing on many corporate employment decisions and real estate
Absolutely.
decisions.
Yeah. No, I think it's great, George. I like this list for all of the reasons that you said, right? Which is it is really a holistic view on any particular market. It isn't just where homes are inexpensive and appreciating, right? It's factored in so many different things. And I'll point out one more thing before we move on, which is, there's also the next 10 to watch, right, as it's called here, is published. And so this is actually a really nice way, I think, frankly, George, for real estate investors, people who are leaving certain markets to other markets, certainly for their primary home, but also for secondary homes or investment properties. I know people in California, for example, near me, who would like to get out of an income property and get into another market that's not California. It's expensive and don't know where to go. And so I think this is actually there's high utility in a list like this. George, is this going to be published monthly, or what's the plan here?
Yes, so our partnership is going to continue, and we're looking at these markets on a monthly basis, which will be interesting to your point to really watch the markets that are up and coming. Exactly as you pointed out, the ones to watch to me were so insightful. I mean, you see two Ohio markets, even further down, Akron and Columbus, right? Clear indication that some of these markets are attracting people. When we look on Realtor.com at cross-market demand, meaning where are people looking to, fascinatingly, a lot of these mid-sized cities are seeing significant shopping demand coming from out of state, which
Yeah.
is what is driving so much of this. And to your point, for investors even, there's a lot of interest right now in a lot of these markets. I mean, think of Burlington, North Carolina, right, between Raleigh and sort of High Point. So again, a smaller market, but in a very high traffic economic corridor, really well positioned for growth.
Yeah, no, it makes sense. George, we've spent a good chunk of time right now really talking about, this report, some of the emerging markets and the reasons behind it. What I want to do is I want to piggyback on that, right? So, whether somebody watching right now is representing, let's say, a buyer or a seller who's looking to move to a different market, right, for whatever reason, or perhaps they're looking from an investment standpoint, for markets to potentially buy second, properties, multifamily properties, whatever. Can you talk a little bit, or can we talk a little bit about some of the Biden proposals as it relates to capital gains and the, well, specifically capital gains, I guess, and what impact do you think that might have on the market right now, right? Because there's some people who are probably saying, okay, I better move quickly, right, before this happens. What's your perspective on that? And has there been any movement with some of those proposals?
I'm glad you brought that up. Obviously, those are very important in terms of real estate. And when you think about capital gains, the other one that I think is worth also discussing is the Section 1031, right? So
For sure.
the like-kind exchange provision, which allows real estate investors to in a sense roll over the proceeds from one property that they sell into another one, right, within 180 days and defer any capital gains taxes. And I think that is such a core part of the real estate market on the investment side that it's absolutely worth discussing. So in relationship to capital gains, the proposal right now where it stands is that we are looking to tax households generally that make over $1 million. So the proposal from the administration is looking to raise some funds from this provision. When I look at the provision, the one thing I think it's worth mentioning to many of our viewers is that a lot of the tax provisions are not indexed for inflation. And so the one thing to keep in mind is many times limits that come with these proposals tend to be fixed. They don't float. And so whereas let's say today, and we saw some numbers, right, that they were saying that less than 2% or so, maybe even less, of the American households will be subject to this.
Yeah.
Whereas that may be true today, when you think about the fact that prices tend to rise over time, 10, 15 years from now, that percentage may be a lot higher.
Right.
And so to me, that's an area really worth taking a look at and debating more vigorously, because whereas today this might not be a problem for most Americans, 10 to 15 years from now, we might have a surprise for a lot more Americans. In addition, I think the other thing worth mentioning about capital gains is the fact that in any given year, the number of folks who may reach that 1 million threshold can churn quite a bit, meaning many folks end up in that tax bracket a lot of times because they are selling a business, a personal business,
Yeah.
a farm, some investment that they have labored at and for over a lifetime.
Yeah.
When they the year they end up selling in, they could basically hit that threshold and get above it, and in a sense get penalized for something that they've worked a lifetime over in ways that I think would discourage a lot of investment. So I would say, to your point, what does it mean for the market? I think in the short term, some homeowners who might be concerned about the impact this would have on them, and here, realistically, to your point, right, you're in California. Think back of the fact many Californians bought a home back in the 60s or 70s. They may have paid $35,000, $60,000. I mean, I know talking to people, they bought in Southern California back in the day market wasn't crazy, they may have paid $60,000 for a home that now could be valued well north of a million, million and a half or
Absolutely.
more.
Yep.
So obviously, this could have a real impact on these folks' bottom lines. So obviously, for some sellers, this might be an incentive to list sooner rather than later, and do so this year. So I guess from one perspective, that would be good for inventory. On the flip side, however, if you are in a position where this is a real concern, you might just as easily choose to hold off from listing, and maybe find alternate means of basically either, especially if you're an older homeowner, leaving the home to your kids, or other ways to deal with this, which I don't think would be as helpful to the real estate market as currently it's struggling with inventory.
Absolutely.
And again, when as I mentioned earlier, when you throw in the Section 1031 like an exchange, right, which provides, as I mentioned, for homeowners of real property, investors of real property, to sell a property, take the proceeds, and within 180 days invest in another one, it basically allows for a lot more liquidity in real estate markets. I think that's probably one of the main reasons commercial real estate markets have been as liquid as they have. The churn and the pace of transactions is higher and healthier. So I think looking to eliminate that provision is likely to, number one, and there have been studies and surveys done on this. And basically what ends up happening, most investors say that what they would do is simply hold their properties longer. And to me, what's relevant, the expectation here is that many times these are well funded, large property managers. The truth is, a large segment of single, property landlords, right? So mom and pop investors are the ones who drive a lot of the Section 1031 activity in any given year. And furthermore, for many investors, when they buy a new property with the profit proceeds from what they sold, they actually make additional capital investments. So it's spurring
Absolutely.
economic growth in the area. So from my perspective, the amount of money that's projected to be raised through some of these proposals makes it a little hard to justify the potential cost in terms of fewer transactions, longer holding periods, all things that, in a sense, have a real economic impact just as well.
Right. George, you said a lot of important things there, right? One is that in reality, this is going to affect a lot of people, right? I know people in my personal family that nobody would consider wealthy, who have who've done some of these 1031 exchanges, right? Or who bought property a long time ago and it's appreciated and would be subject to this. Or people who have, to your point, I think an important one I think about as a business owner, is people who have worked their entire lives, whether it be a farm or a small business, and sort of that one-time payday, maybe before you retire, you're looking forward to, is going to be impacted significantly from a capital gains standpoint. And then with respect to the 1031 exchange, your points there I think are really well taken around, maybe slowing, the pace of sales and certainly the investment that goes into it and the, capital improvements and things like that. Let me ask you this, George, how likely is this to happen, right? We know that there's, control of the House, there's pretty balanced but slight control of the Senate, right? What do you think the odds are of this passing, or what do you think might happen here, and when might we know?
Well, it's obvious to me that the administration is working on multiple fronts to address quite a large number of priorities it outlined for really the next few years, right? I mean, we have the budget on one hand, we have an infrastructure plan on the other. So there are a lot of priorities here on the table. And ultimately, the benefit of having a Congress is that you want people to debate the benefits as well as the costs of these issues. So when I look at the myriad items on the agenda, I think that there will be a give and take on this issue. Realistically, I'm not sure how many of the high dollar items are likely to pass, given that there is reluctance on the other side of the aisle towards such big spending. And even more so as we're seeing the economy rebound, right? So there is still a looming question. We have spent literally in the last 12 months about $5.3 trillion in terms of of fiscal stimulus between the various packages that we've seen. And so this money at some point, has to be repaid, right? So federal government has to pay for it. Right now, the interest rates are really low, so the debt burden is low. But if we continue adding to this debt burden, that might have down the line an impact, particularly in crowding out private investment, in financial markets. So I think there's real concern that simply adding on additional dollars to this might not be warranted. So a long-winded answer to say, to me, it's yet unclear what the likelihood of this particular proposal on capital gains and 1031 is likely to pass, or specifically when. Obviously, the administration is trying to make headway as soon as possible, but I think these are all topics that are very much warranting thoughtful discussion.
Absolutely. Absolutely. George, this was a great overview. I appreciate you taking us through the Emerging Housing Markets Index. I think that's really useful, especially because things are changing so quickly. Is there anything else that you wanted to touch on today that I didn't cover?
So the one thing I'm going to simply add is, especially as we look at the market, this spring, right, in sort of the thick of it, and with an eye towards summer. We just looked recently and released results from a survey we ran of sellers, asking homeowners across the country, number one, are you planning to sell your house? And to me, intriguingly, 10%, and we partnered here with Paris and surveyed a large representative sample of homeowners across the country. 10% said they would and are planning to sell their house this year. Why is that number, to me, interesting? In a regular year, and we used 2017, 2019 pre-pandemic as a baseline, about 8% of owner-occupied houses come to market, get listed on Realtor.com. The fact that we have 25% more homes likely to hit the market this year is, to me, a significant indicator, particularly given how tight the market is and how much we struggle very much with this issue of not enough homes for sale.
Yeah.
So in addition of those 10% who are planning to list this year, many have already taken steps, either basically talking to an agent and preparing it, others remodeling, getting, researching their home value. And to me, that's significant because it tells me we're likely to see a very welcome development in the next roughly 3 to 4 months, which is an increase in the number of homes for sale. And what was also insightful to me from that same survey, we asked people, how much do you expect to list your home for? And fascinatingly, we basically had about, I would say, I think 40% or so saying they're planning to list their home at 350,000 and lower. That's huge. Why do I think that's huge? Because that's the very entry affordable point of the market.
Right. And these first-time home buyers are struggling right now to find a place to buy.
Exactly. And in addition to that, another 28% of homeowners said they were planning to list their home between 500 and 750,000. So almost a third of homeowners are planning to bring homes at what I consider to be the mid-range of the market. Why is that crucial? Many sellers have been stuck in their homes because they can't find a replacement home.
That's right.
Number one, or one that's affordable. So to have a third of homeowners plan to put their home markets in that crucial 500 to 750 for the trade-up buyers is also significant. It tells me that we're possibly looking at a much healthier, by historical standards, housing market this summer. And when we track our data, as we've been tracking it weekly since the pandemic. The last 3 weeks, we actually saw the number of new listings. So basically, homes hitting Realtor.com right on the platform actually begin to pick up compared to to the prior year, which is a really welcome news because price growth, the kind we've seen in the last year, 15, 17, 18% year over year, is obviously not sustainable in light of broad economic reality. So to see this influx of sellers into the market bring some balance back, I think is extremely welcome and really promising for many, especially first-time home buyers.
That's fantastic. That's great. George. Thank you for sharing that. I think that's important news that, frankly, I didn't realize. I've been looking at this stuff pretty closely, but I didn't realize that some of that survey information, and like you said, to give people some hope, I hope, fingers crossed, right, that some of these first-time home buyers who are getting priced out of this market and to see some normalcy come back into it. And I think importantly, to your point, for the people who have the quote-unquote starter homes to be able to move up into something a little bit bigger or better. I think that's fantastic. George, thank you so much for everything, always taking the time to do this. It's incredibly valuable, and I appreciate you, and I know that all of our agentpreneurs appreciate you as well.
Absolutely, Randy. Always glad to chat with you.
We'll talk to you again real soon, George.
Certainly.
All right. Well, there you have it, everybody. I think another chock full of good information episode with George from Realtor.com. Definitely all of the links are below for Realtor.com, as well as the emerging housing market index story that we just covered. I think there's a lot of really good information there. I think there's some signs of hope maybe in terms of what the market's going to do in terms of an inventory, and hopefully getting back to a more regulated pace of home price increases. It's a little bit hectic right now, that's for sure. So anyways, that's it for today, everybody. Please consider subscribing to the channel while you're here and click that little bell so you're notified. Until tomorrow, be safe, be healthy, be happy. We'll see you soon. Bye.